Hello, everybody. Welcome to today's episode of the Daily Dose. Today is Tuesday, November 8th, and there was a lot going on today. Obviously, we had the midterm elections, which will most likely have an effect on short-term stock market volatility and moves, as well as a couple earnings. Big company, Walt Disney, reported today after the bell. And we also had some action going on in the crypto space aside from just the price volatility. FTX went through a liquidity scare. They paused withdrawals, and now looks like Binance is going to buy them out. So that was pretty interesting as well after we got all the articles about the founder of FTX. I forget his name. It's like JBM's. I don't know. I forget. But after all, he was going to be the next Warren Buffett, and now his company basically almost went bankrupt. So that was interesting. But so a lot going on today. Stocks ended green. The S&P was up like 0.5%. Same with the NASDAQ. Dow Jones was up 1%. Still seeing the Dow outperform, which I think is interesting. But let's get into this article because I don't want this to take too long. And I will just say before I get into this, if you like this type of content, please subscribe on YouTube and follow wherever you listen to podcasts. It would mean a lot to me as I try and grow this channel. But let's get into it. So stocks rallied Tuesday as investors awaited the outcome of the midterm elections in the United States. We already talked about the performance today, so we'll skip that. It was the third straight day of gains for the major indexes ahead of another week of potential market-moving events, corporate earnings, midterm elections, and inflation data. So we haven't even gotten to that yet. That's on Thursday. Investors are focused on Tuesday's midterm elections that will determine control of the House and the Senate for the remainder of President Joe Biden's first term. Historically, Wall Street has preferred a split Congress or White House with political gridlock that could impede major policy changes, an outcome that investors see as favorable for equities. And you might think to yourself that makes sense, but why does it make sense? And it's because markets typically do better when one party isn't pushing their agenda, and they don't have any sort of pushback. So when Republicans have major control and they're passing whatever they want, they're limiting government spending, they're lowering taxes on corporations and businesses, and in the short run, that's really good for businesses and good for markets, but in the long run, it's really bad for the working class. It's bad for just everyday Americans. A lot of their resources are cut, and it's really good for corporations, really bad for everyday people. And so it can be good for the stock market in the short run, but not good for society, which is in turn not good for the stock market in the long run. And then you have the Democrats, when they're in office and have control, you'll see some more government spending, which can be good for stocks in the short term. But again, in the long term, you might see inflation problems. You might see higher taxes on corporations, which is not good for the markets in the long run. So each party basically, if they take control completely, can be good for stocks in the short run, but then bad as they just push out their agenda without any pushback. So usually investors like to see split Congress or White House so that we're not getting that just wave of legislation passed from one party that could affect the economy. According to JP Morgan's latest client survey, 39% of respondents were split on whether the U.S. midterm elections would be a positive catalyst for risk markets or non-event, with 21% expected negative implications. That's interesting. I wonder why they think that. That's interesting. Regardless of the winner, some strategists argue that midterm outcomes have a modest influence in financial markets. The overall near-term implications of the 2022 U.S. midterm elections are quite modest for FX markets, Mira Shandon, FX strategist at JP Morgan, wrote in a note to clients, markets should thus continue taking guidance more from the Fed's monetary policy decisions than any new large fiscal packages. One wild card worth flagging is the risk of renewed uncertainty about the debt ceiling. I kind of agree with what she's saying, but I think people are looking too much at the elections and not looking at the Federal Reserve. It doesn't matter who gets elected in Congress because the Federal Reserve is independent from that, and they're going to continue to push their own agenda, which has a way bigger effect on the economy and the stock market than any legislation that could get passed right now. The way that they're raising rates and tightening them right now, that's really what we should look to, and not towards the elections, which could have an effect. They could have an effect, but historically, markets do what markets do, no matter who's in power. And usually politicians point to markets when they go up and they're in power and say, I did that. And then when they're in power and markets go down, they say, well, I couldn't get anything done because the other people were hindering me. So they point to it when it's an asset, and just delegate the blame to someone else when it's a liability. Like that, it's all a game. But as far as real effects on the market go, I'm looking to the Fed, not really putting as much weight into the election. Another closely watched item this week will be Thursday, the release of the October inflation data. Economists surveyed by Bloomberg expect headline CPI at an annual rate of 7.9%, which is still absolutely horrendous, down from 8.2% the month before. And I just want to say, because we're on the topic of headlines, just because the Democrats are in power right now does not mean that they were the ones that caused inflation. Now, I'm not saying that they're free of blame here, but a lot of the stimulus that came into the economy, and rightfully so, it should have come into the economy when it did, was from Trump and the Republicans. And so I think it is misguided to place blame on a political party for inflation or bad stock market performance. I think that that's just ill-informed. But I do think it's kind of funny when people place all the blame on Democrats when all of this stimulus was being passed and pushed out by Republicans. And I would say the exact same thing if it was flipped. Like, I have no partisan bias towards either party. I won't get into that, but yeah, definitely don't have a bias one way or the other with that. I just like to point that out since we're on the topic. Quote, the problem is going to be that in month-over-month terms, I think we're still going to see a fairly strong core CPI, Franklin Templeton fixed income CIO Sonal Desai told Yahoo Finance Live on Monday. And before we finish the quote, I just want to say we covered this in the weekend video, which actually came out yesterday. So if you haven't watched that, go look at that, because we talk about the core CPI and how it's actually trending upwards, and that could continue. And he goes on to say, and I don't think that a combination like that together with the relatively strong jobs numbers we got on Friday is going to give the Fed much comfort in terms of changing the path, which was outlined by Chairman Powell last week. So basically he's saying, we're going to continue to see high inflation, and we got a strong jobs report. So like, it doesn't matter who wins the election. The Fed's going to continue to be overly hawkish like they're being right now. That's going to continue. There's no reason for that to stop right now. Nothing's broken. And they're getting all the data that they want. They got a strong job market, and inflation is still high. So they have all the ammunition they need to keep going. And I'm not saying that just because nothing's broke that they're not doing the wrong thing. I think they should have started tightening earlier and not gone as fast as they are, and maybe not go as high as they're going to. But this is the world we live in. So you just have to know how to react. So that's interesting. Some Wall Street banks, including UBS, expect the U.S. to head into a hard landing. Yeah, no kidding. Indeed, Federal Reserve Chair Jerome Powell said last week that the path to achieve a soft landing has narrowed, just like the path for transitory inflation has narrowed, because the Fed hasn't seen inflation coming down. The U.S. economic expansion already looked precarious. After one of the most rapid recalibrations of monetary policy in several decades, the full effects remain to be seen, Jonathan Pingle, managing director and chief U.S. economist at UBS, wrote in the bank's Global Economics and Markets Outlook for 2023 and 2024. Quote, with meaningful imbalances remaining in the U.S. economy as a result of the pandemic, we expect 2023 to bring an economic downturn or correction. So just continuing what we've already been in, I guess, in 2022. The good news, resolving the tensions we think sets the U.S. economy up after 2023 for better years ahead, he added. So that's good. There's a lot of people that are talking about another lost decade. that stocks are just going to stay flat or go down for the next 10 years, but they think that after a tough recession, we'll come out of this stronger. Meanwhile, in a new note from Goldman Sachs chief economist, Jan Hatzius, I'm sorry if I'm just absolutely botching that, put the likelihood of a recession in the U.S. over the next 12 months is 35% amid the central bank's aggressive tightening moves. I wouldn't be surprised if the actual probability of that is much, much higher. We still see a very plausible non-recessionary four-step path from the high of inflation economy of the present to a low inflation economy of the future, Hatzius wrote in the note. And then it goes on to talk about some corporate earnings, but I don't want to talk about that right now because that's not what I would focus on today. So let's look at the S&P 500, kind of still in the middle of no man's land, approaching our zone where we could see some selling pressure around the 3,900, kind of the 3,895 right here into this zone. That's where I'd expect some serious selling pressure if we still rally. Say we get some sort of rally if the Republicans win strongly and we're going to get that split power, then this would be a zone where we could see some selling pressure. Let's get the 200-day moving average up here as well, because that is going to be not too much higher after that. So around the 4,080 is where the 200-day moving average is sitting right now, and that'll act as a pretty tough level of resistance if we get there as well. And then to the downside, obviously, we have the lows that have been in place since October and June, if you want to count that. That'll be a place of support still now that we're still above it. But if we do get another leg down, like I said, I'm still eyeing that 3250. I think it's a good level for us to go next if we see some more selling pressure. And I definitely think that's likely if the Fed continues to tighten and be as hawkish as they're being. I think the market really it tried to get prepared for what the Fed's doing, but it kept hoping and hoping that there's going to be a pivot or that they're going to soften up, and it's not happening, and there's no reason for them to soften up yet. So I'm eyeing the 3250 as another leg down if it occurs, but that's not saying that we can't go higher first. We definitely can go higher first. Let's take a look at Bitcoin because I'm quite proud of the levels that I have right here. So we surged, and I said, hey, you got to be careful because it's still in its range, and Bitcoin's had a history, especially in this bear market, of rallying into a sell-off. Well, guess what? It rallied literally into the top of our zone, so right here around the 21,300, and then it started selling off, and guess what? This wick here literally stopped at the bottom. I didn't adjust this to make it look like this. This is the zone we've had on there for months, and it stopped right at the 17.7. Right at the 17.7 is where it stopped. And I said that's the point of no return. We break through this 17.7, 17.5, and we're going much, much lower. And we touched it, and we've bounced off. So I'm watching Bitcoin like a hawk right now because I have a little stash I'm waiting to put into Bitcoin. I've been waiting to put it into Bitcoin for a long time. If you've been following the show, you know that. And we definitely could see 9,000 to 12,000 on Bitcoin if we break through this level. The 17.7 held for now, but that's the first time it actually got touched since we initially came into this range back in June. So really, really fascinating stuff happening on Bitcoin. And I'm interested to see where it goes from here. Definitely watching it really, really closely. I got a bunch of price alerts set for this one. So that's interesting. But I'll leave it here. Again, if you like this type of content, please subscribe on YouTube. It'd mean a lot as I try to build out this channel, and follow wherever you listen to podcasts. That would mean a lot as well. I do appreciate you listening or watching to this episode. Crazy week we got, so make sure to stay tuned for all that this week. And until next time, I really appreciate you watching or listening to this episode, and I'll see you in the next one.